Give it up for Danielle DiMartino.
Danielle DiMartino.
Danielle DiMartino Booth.
What does the bloodless vertical of the market today tell you about Liberation Day yesterday?
Well, it obviously is expecting lower earnings. It's expecting lower growth and perhaps expecting higher inflation. But this isn't the start of something. This has been coming on for a while. I mean, the last Fed press conference, they had the dots, and they reduced their expectations for real GDP, and they increased their view of inflation. So we were already moving in a direction that wasn't terribly healthy. But I really think the real problem in the market is, tariffs are sort of a convenient excuse, but you sort of had the cannon loaded for something bad to go wrong. You had valuation of risk assets that looked a lot like year-end 2021. And of course, that preceded the 2022 bear market. And you had a sentiment setup that I was saying in the last parts of 2024 felt almost exactly like the end of 1999, where all you have to do is replace .com with AI, and you're kind of there. And this idea that risk assets were invincible, beyond invulnerable, invincible. And then the market started to fall a few weeks into the year. And as it always does, the rhetoric pivots to, well, stocks are down a little bit. Maybe we're going to go down 10% or something. But credit spreads are really well behaved. And that's easy to say when you're a generalist economist working for Dewey, Cheatham, and Howe. But if you're really watching the market on a daily basis, the spreads were widening. And spreads widened the way that the sun also rises, goes, the character went bankrupt, slowly and then all at once. So while I was watching commentators say this, I was observing that, well, yeah, spreads are out 3 basis points. I'll just talk about high yield as a proxy. And then they were out 10 basis points. And then they were out 30 basis points. And that was basically on Fed Day. And I do that thing with Scott Wapner right after the press conference. We're doing it for 3 years. And I said, spreads are not contained. They're already out 30 basis points. And I've seen this movie so many times. The next move, they're going to be out 80, and then it's going to be 150. And within a couple of weeks, they were out 100. The spread was down to 250 basis points. And then it was at 350 a couple of days ago. And I don't know where it is today. Treasuries are up, the 10 years probably up down a few basis points, and junk bonds are down a couple of points. So I guess you're out at 180, 130.
Yeah, it seems reasonable.
Probably 130. So it's kind of a sequencing thing. It's one thing that is good to have experience if you have a certain gene, which I think it's probably made my career. I have an emotional memory. Not just a factual memory, but emotionally, how it feels. And it's helped me a lot. It helped me a lot during the credit crisis when everyone thought things were cheap, when they had gone from 100 down to 93 price, bonds that had never been below 100. And we actually there was a margin call, and we put out what we thought was a throwaway bid. They were talking, it was from Thornburg Mortgage, which was actually an excellent underwriter, but they got over leveraged. And they were talking, it was a couple $2 billion, and they were talking this list at 98. And the day before they were at 100. And I put what I thought was a throwaway bid at 93. And we got hit on 300 million. And some of the more junior guys on our trading desk, one of them in particular, who's kind of emotional guy. I call him the crazy Russian billionaire because he's crazy in Russian. He's not a billionaire yet. But he just says, "This is the cheapest bond I've ever seen. This is the cheapest bond." And I said, and I just got this crack of doom feeling, like I felt this before. I remember when we thought back in 1994 that there's a certain sector of the market was too cheap and it went down by another 30 points. And I said, "You write that on the ticket. You're signing the ticket. You're writing it on there, cheapest bond ever. We're tacking it up on the wall." I said, mark my words, because the yield at 93 was 8% to a par payback, and they had never traded 8%. They were always 6% up at par. And I said, write that on the ticket, but mark my words, these things are going to go to a yield of at least 14. And I think I actually said 14, but when I said at least 14, I meant in the teens. And I was directionally right, but I was order of magnitudes off because they went to yields of 40%. And that's to no losses, so you couldn't really assume that. But to an incredibly rigid and strict default assumptions and loss assumptions, the yields were 24. You knew that it wasn't going to yield less than 24 when you got them on in March of 2009. So I don't know. I think this is going to take a long time to play out. It's obviously going to hurt people who now have moved their supply chains from China to Vietnam. And now they've got, 76% of Vietnam? 46%? I don't know. There's so many numbers out there, and they're also different. And it was surprising yesterday how at the close, the market liked it because they heard the 10% that came out with the Wall Street Journal. Then all of a sudden, no, it's 26, 24, 27. It depends which analyst you look at.
It was the minimum of 10.
Well, it's kind of the average.
Right.
Yeah, the minimum's 10%, and now it's like 27. That's higher than the Smoot-Hawley tariffs in, when was that, 1930? Mm-hmm. So I don't know. It seems to me that it's early innings of this saga on tariffs, and Canada's going to retaliate. And Macron put all kinds of flowery language about how this is immoral and it's like crazy stuff. I mean, it's funny when somebody has the better side of an economic deal. Of course, they're the ones that don't want it to be taken away, and that's the problem we have with this. Is really trying to get the trade deficit down in simple terms. He frames it as stealing and cheating, but the trade deficit has exploded. And it is exploded, as we used to talk about in the 80s and 90s in tandem. We call them the twin deficits. It's exploded in line with the budget deficit, which never goes down. In fact, the budget deficit as a percentage of GDP is higher now since October 1, so through the first 6 months of fiscal 2025. It's higher now than it was in fiscal 22, 23, and 24. It's kind of incredible, right? That those were years, particularly 22, of tremendous stimulus that caused tremendous inflation. And what's also fascinating, fun fact to know and tell about that is the bonds issued in 2024 was the same amount of coupon issuance from the Treasury Department as 2022. 2022 is this year of trillions of dollars of cash being thrown all over the place. How is it that we're borrowing more now than then? Well, a lot of it's the interest expense. And the interest expense is headed towards $2 trillion pretty quickly. It was at $0.3 trillion, $300 billion a couple of years ago. And these are actually the same problem viewed through a different lens. And as people are realizing that they didn't really know what to expect from the tariffs, they were different than they expected. It's not really Mexico and Canada, it's mostly Asia. And that's a big, Canada and Mexico, of course, are our biggest. They export the largest percentage of their exports to the U.S., 80% for Canada and 75% for Mexico. But the tariffs are much different than people expected, and it has to be digested. And I would bet any amount of money that today's close is not the low.
Yeah. So Danielle, I think about some of the stuff you've written about too, about with Trump, and the old trading adage was, you take him serious but not literally, and you've been warning about risk assets for a while, and I think when you look at Wall Street economists, they're calling right now, they're trying to update the forecast here, but if you look at what happened, is that this was the worst of the worst. I think is what they said of the forecast out there. And no one was even in the ballpark, right? What are these implications now? Should we be taking Trump much more literally? Because he's laid this all out. It's the market that was saying, no, he can't be serious. He can't be taken literally. Where do we sit in all of this right now? And what does it mean from an economic perspective?
So as he was getting ready to leave and go to Florida, he took a few answers this afternoon out on the White House lawn, and he reiterated what he's happy his lieutenants out there on Bubble Vision saying, starting with Howard Lutnick in a very extensive interview this morning on Bloomberg. But he reiterated that it's a patient, and as long as the patient survives the operation, then it's going to live. I liken this to Trump, and two things happened over the weekend that I think were really indicative of where we are. He said he would consider a third term, which nobody wanted to hear. And he reiterated that he's willing to take this pain. Now, chatter is that Lutnick's on his way out, and he won't survive until Sunday, that Musk is gone as well. I mean, the rumors are just flying left and right that he won't stand for this level of pain in the stock market. But to your point, Jeffrey, what if the market was looking for an excuse? What if the market was looking for an excuse on NVIDIA Monday? Look, I wrote about DeepSeek and published on it last August because I saw a chart that showed that the United States had 5,600 data centers, China had 500, and Germany had 500. I'm like, well, there's something going on here. Somebody's throwing good money at bad. This is like fiber optics 2.0, and I'm not even doing a deep analysis here. But what I tell people is happening right now, and I think that the focus has to be China, is Trump trying to get at what went wrong the first time. That's that we moved our supply chains a little bit to Vietnam. See Nike stock today. And even to the extent that we friend-shored, China's made gigantic inroads all the way down to the Panama Canal. And that was the other thing that happened this past weekend, was that deal fell through about the two ports being sold, because I don't think Chinese officials want to let those two ports go. But I see where we are today. If Trump is truly willing to take the pain, I almost don't think he can step back from this and say, we're going to do a reset, because momentum is a funny thing. We talked about momentum in January, and as long as it's on your side, it's fine. But again, DeepSeek Monday told us what we needed to know, and that was that there was a big, huge air pocket, that the market was looking for an excuse. And what we learned this afternoon was structure. You've had all of this financial innovation, just like subprime mortgages, all of these levered ETFs, and they all look good and sound good until they're tested. And at the close today, they were tested. And that's why markets closed at their lows, because that's how leverage works. It's not that margin has disappeared, it's that it's transformed and taken on a new way of transmitting into the markets. And we were talking right before we came on stage about why banks got hammered so hard today. JP Morgan was down 7%, Citi was down 9%. The Russell 2000 was down 6.4%. So the banks were down even more than the Russell. And it's what we've been writing about. It's this 20% year-over-year growth in loans to non-depository financial institutions. And you're going, what the heck is that? It can be anything from private credit to the fund families that have these levered ETFs, but who's lending to them? Who's financing them? Who's funding them? The biggest banks. And they're making a ton of money on it. And that works until it doesn't. And I would just add one thing. It wasn't just DeepSeek. And I think DeepSeek was released publicly, strategically, after Trump was in office, because the paper itself came out last May. So I think they were waiting, because I think that China understands that it's not in a trade war with the United States. It's not in a currency war with the United States. It's in a Cold War with the United States. We just happen to be engaged in economic warfare. So if you're engaged in economic warfare, you hold something like Deep Sea back, and then you launch it as a missile, and you be the first. And they beat Trump to the punch.
Yeah. So I've got a couple of comments on what she said. The first is on market structure. She's absolutely right, of course, and there's tons of leverage, and someone's going to go broke on this thing. But what I think more simplistic about market structure is when you have 1999 repeat in 2024 and you get a bigger and bigger and bigger percentage of the gain coming from a smaller and smaller and smaller group of stocks, you get to a point where the market capitalization index fund is pretty dangerous because human behavior has encouraged people to just do what they think is easy because the S&P, as the Magnificent Seven, are going up a lot, and they're getting to be a bigger and bigger percentage of the S&P 500 market-weighted index. The investors just say, this is doing better than active managers, this is doing better than every other index, the more narrow concentration, and you're not diversified at all. And it becomes a self-fulfilling prophecy that the S&P 500 outperforms because of 7 stocks, it outperforms other indices, and that encourages people really sort of moronically to buy the S&P 500 equal weighted. And that just creates this ongoing overvaluation, getting a bubble blown up more and more and more, and then all of a sudden,
market weighted.
They break, and then suddenly the S&P 500 is underperforming the Dow, and the Russell 2000 is a disaster too this week. And then the other thing, so there's that aspect of the unwind of long-lived, powerful markets that get narrower and narrower. It has a lot to do with herding mentality, and you're setting yourself up for huge underperformance of those stocks, which of course has happened. One short comment: I didn't know who Ludnick was until he was picked, and I saw him interviewed. For the first time, I saw him speak. He was on TV being interviewed, and I was like, "Uh-oh, like we're in trouble with this guy," because he was making statements that were so sophomoric. I was sort of stunned that he was such a serious, executive type of person. He said, within 2 years, we're going to have a balanced budget and we'll have 5% real GDP growth, which is mathematically impossible. I mean, come on, we have 7% deficit percent of GDP, so we're going to get that down to 0 in 2 years. That's going to drag 3.5 points out of GDP each year, and we're going to have 5 real, so we're going to have nominal GDP go up by 8.5%. It's just, where's that supposed to come from? It's a lot of this magical thinking that I think is a credibility problem potentially for the administration. And I don't know, Musk has to leave in May, I guess, unless they change the deal. I mean, he's a temporary employee, so him leaving, being announced in April, he's leaving in May. I mean, that doesn't sound like much of anything. But it's interesting how much pushback there is on cutting government spending, because everybody knows that we need to cut. Everybody knows that, but it's this thing, like, don't cut you, don't cut me, cut the man behind the tree. Right? Nobody wants them to be cut or anybody they know to be cut. They want to see some invisible person.
Well, they did cut the man behind the tree. They cut the people at Yellowstone right before spring break. So it has not been done logically.
But it's interesting.
And there's so much low-hanging fruit if you just consider how much waste there is in how Medicare and Medicaid are operated. You don't even have to fire people to save a couple $1 trillion there.
The amount that I've come to the belief that the amount of spending at the federal level that needs to be cut is tautologically equal to the budget deficit, which is $2.2 trillion. So we need to cut $2.2 trillion out of the budget. We can do it rationally, or we can go bankrupt and have the market force us to do it, because 28% of the government's spending is deficit. And it's going to get much worse with this interest expense problem. So I know why Scott Bessent wants to bring the 10-year down. They'd love the rates to be at 0.
He's getting what he asked for, isn't he?
Yeah, he's not the way we're looking for it. But so the cuts of Doge had tremendous resistance. Now there's lawyers trying to undo it, the judges trying to undo them, and then we see the tariffs, and now that's turned out to be way more difficult than the market predicted. And all of these problems are going to be solved, but there's going to be, I think the detox that Bessent said is correct.
So if I could add one more thing to the spreads discussion, because a few years ago, Janet Yellen said she was concerned about high yield exchange traded funds, and that really worried me. That's like when you see like man of the year on, the front cover of magazine right before he goes down in flames in a scandal. I'm like, if she's aware of it, then something's really, really wrong. But to your point about spreads and spreads being indicative or lack thereof, when you think of 2007, the last time spreads were as tight as they were, I remember June 2007. I was working for Richard at the time. But the last time spreads were this tight, we didn't have $1 trillion plus fixed income ETF universe. And what we have today, though, is $1 trillion plus fixed income ETF universe. So what you see in spreads is not the high yield universe. It's the most liquid names that trade when there are inflows and redemptions. And on days like this, my point is, if you do see spreads gap out, that means that it's not the liquid stuff that's trading. It's the stuff that hadn't traded for years that trades by appointment only. And that's when you really start to get into trouble, and you see yields gap up by magnitudes of what you thought they could be at their worst.
We actually saw that last month. You saw that when the high yield was weakening, and our high yield PMs were talking about this and saying that it's the single Bs that are hit the worst. And you're saying, wait a second, it should be the triple Cs. Well, there was no appointment to trade the triple Cs right now. It was trying to raise liquidity at that point in time. So it's very emblematic of when you have those stresses. Can I come back to the tariffs one last time real quick? And what I want to talk about is the tit for tat, because what Jeffrey said with Macron, there was something also that jumped out at me today, is that, I feel that because we're so early in this administration, this is my personal view, that there will be more tit for tat retaliation here. And because you can't let the bully do it knowing let's just assume he only has 3 years and 10 months left, right? You can't let him win early on. You've got to push back early, right? So what I saw also from Macron today was that he wants to limit French companies from investing in the U.S. And it reminded me of a comment that's something we've been talking about, Jeffrey, internally, is the amount of investment in this country from foreigners. And so we may have this idea about the trade deficit, and we're trying to balance that out. But the tit for tat can have knock-on effects way downstream. What happens in that scenario? I mean, are we just in this global recession at that point where no one wants to do business with us?
I don't think
it seems extreme.
I don't think you need to know the answer to that. I think a question that's simpler and I think easier to answer, but from the same neighborhood, is in 2016 the net foreign investment position in the United States was $2 trillion. So there was $2 trillion of foreigners investing in the U.S. more than we were investing. So the net position was -2. Here we are 19 years later, and it's about -28 trillion. That explains why the U.S. has had this incredible run of outperformance versus the rest of the world for at least 20 years against emerging markets, almost nonstop, and against Europe, also almost nonstop for at least a decade. And why did that happen? It didn't happen because we're some sort of superhuman race in America. It happened because the foreign position grew by $24-25 trillion. So if we're and that's part of a system in which people were by and large getting along, and they somehow liked the situation of investing in the United States. And with the rancor that's going on now, if you just read the headlines today with Macron and Canada, and I'm sure there'll be others, it seems highly likely that the foreign investment position is going to be pulled, at least some of it. So will it go down to 2 or 3 trillion? I don't think you need to know the answer to that. What if it goes down to 15 trillion? Just drops roughly in half. That's a massive amount of liquidation of U.S. assets. And it's all these megatrends that have been in place seemingly for forever, to my eye, and I've been talking about this now for months, have reversed. Europe is mightily outperforming the United States recently. Maybe not today, I haven't seen it, but mightily. It doesn't look like it's just a wiggle and jiggle like it was on the way up. It's like boom. And I think that's going to continue because we're divorcing from Europe. Germany's being encouraged by our actions and by how we're dealing with a more isolationist type of global militaristic concept, it seems to me. I think that Europe is going to continue to outperform. And it's always meaning for years, been a real valuation trap because it was cheap forever and it was never working, cheap but getting cheaper relative to the U.S. But that's changed. And that's also changed, as I alluded to earlier, equal weight is outperforming market cap weight. And I think that's going to continue. I think that's going to be a theme for this entire year. And there's a lot of those trends, growth versus value and all that sort of stuff, but that's less convincing on the charts. But the one that really strikes me is U.S. versus rest of the world. And the other thing I find curious about the recent action is I've been predicting that when the market rolled over and when we went into recession, something strange would happen, that the dollar would go down and U.S. would underperform. And everyone says that's not the way it works. I've been around 40 years. I know that when there's a recession, the dollar goes up, and when there's a recession, the dollar outperforms. And I say, well, that's during a different regime than what we're in right now. Everything kind of changed in 2020, 2021. Interest rates bottomed, and we're in a secularly rising interest rate market now. And people say, you're crazy, rates go down when we go into a weak economy recession. Well, I've got news for you. Today, a day of a very sharp stock market correction, obviously. Bonds had a rally. What did the long bond do? It underperformed the 2-year. The 2-year had a bigger gain than the long bond today. So I think I'm onto something here, that the long end rates
You're talking price, just not the yield difference. You're talking price.
I'm talking price performance. That's right. And I think that in this environment that we've entered, I think that interest rates on the long end, I predicted this in October of 2023. I said, when the economy is perceived to be weakening, we'll have a knee-jerk rally because everybody thinks they've seen this movie before because they've been around for 4 years, so they know what's what. Well, sometimes experience can be a hindrance because what you think you know from your experience is informed by a regime that may one day change. And I think a rising long-end interest rate regime is a real regime change. And so today, bad markets, dollar went down a lot today. So again, people are now talking out in public about recession. Today, I watched CNBC for about 15 minutes, and the debate was, are we in a recession or a depression? That's what the debate was, So everyone said, probabilities of recession have gone up, depression's off the table. So, and I don't know, we only have one depression example, so I'm not really sure you should map it over. But all that stuff is happening differently than it used to. So all of your experience, all the things you think you know, all of your assumptions of what relationships are, you need to put them in the mirror and look at them, that they're going to act the opposite way. I'm sorry, Danielle.
Well, actually, Jeffrey, I think you're onto something when it comes to second derivatives. 3 things that I'll point out. One of them is going to leave you with a deep thought, not like Saturday Night Live, but in the JP Morgan Global PMI, 34 of the last 37 months have seen contracting new export orders. So we have been in a nasty global trade recession for a long time. And as you know, you read what I write, starting points matter. So the starting point is from a very weakened position, and there's been a ton of preemptive moves by countries prior to these tariffs being imposed. The second thing I would bring up is it's not necessarily goods that we're talking about when it comes to the potential follow-on effects of tariffs. This morning in the S&P Global non-manufacturing PMI report, we saw that there was a collapse in new export orders of services. What is that? It's people not visiting the United States, because that's what a service export looks like.
Yeah, I don't know what it would be.
And we're making enemies left and right. But
if a foreigner comes into the United States from Canada for a knee replacement or something, Is that a service import?
Yes.
Yeah. Okay. So
Well, also,
that's tourism too.
Well, it also depends on where the knee was made. So,
Yeah.
anyways, but yes, the doctor portion is a service export. Sending your kid to university in the United States is a service export. But we're seeing that get hit really hard, and those are real dollars. But here's the deep thought. If we impose punitive tariffs on Madagascar and we import a bunch of vanilla from them because it's just not something we produce a lot of, how does that affect them if they don't necessarily import anything from the United States but Google searches? So this is this point came up this afternoon in my Bloomberg chat room, and it's exactly what you asked. Could you see higher tariffs on goods manifest as lower services spending into the United States, and that end up being, and I think I ended up calling it, a second derivative boomerang effect? And all of this ill will, it can manifest in areas that hurt the U.S. economy more because we're 80% services. And people can turn away from what we sell. So you're onto something. And I don't think you should let that go, because it's not going to be as simplistic as what are the effects of reduced goods trades. And to Jeffrey's point, there is, I think, an almost perfect correlation between foreign inflows and the S&P 500.
There's, of course.
And it has been
more
for
buyers
years.
than sellers.
Yes. And it's been that way for years. But, you saw Switzerland 2 weeks ago, I want to say, or 1 week ago, say that their sovereign wealth fund was looking at liquidating its U.S. stock portfolio. I mean, these are real developments that can pile on to what domestic investors are doing.
Also, we talked about markets looking for an excuse. Well, I think one thing that did change potentially today is there's enough shakeup going on with these tariffs, being digested and all that, that you get to these moments where suddenly it becomes okay to write stuff off because you blame it on this general atmosphere, and perhaps lay people off. If you start a psychology where company A laid off 10% of its employees and company B did, and your company C, and you've been wanting to trim the workforce a little bit, it becomes safe. It's okay to be doing badly with a crowd.
Yeah, it's like a one-time currency charge that becomes contagious during earnings season.
And I think I worry that might
ways.
happen. I think the earnings calls that are going to come up are all going to have
It's
predictable language.
It's going to be a competition.
It's like when the Palisades fire burned down a small amount of my house, thankfully a very small amount. It's like everybody has the ability to just point to that in terms of like local matters, and and that just becomes it's okay to blame everything now on Karen Bass, and the heroes have become the villains.
And companies are looking for an excuse, right? Because this is the social media age. And this is when people are like secretively filming HR firing them and then going viral on TikTok with it.
Yeah.
Going into the election, it was such a sensitive issue. Nobody wanted to announce mass layoffs.
Right.
So you'd find out that Verizon's headcount had reduced by 4,800 employees, and they'd taken a $2.9 billion severance charge. You find out about that after the fact when they report their earnings, because companies don't want to make these nasty announcements right now. It's bad optics, but now they have an excuse.
I'll give you another analogy on that. When the Fed starts raising interest rates, leverage investors start earning less because their borrowing cost is going up. And you get to a point where leverage investors start doing negative returns. Well, that affects the closed-end fund industry because they're leveraged and the borrowing costs are going up. But it becomes a point where when you have to cut your dividend because the earning power is going down, if you cut your dividend alone, you get like Bloomberg headlines, and it's in the Wall Street.
Walgreens cut their dividend for the first time in 93 years. That was a headline, 93 years.
Yeah, but this time, with the Fed hiking rates 125 basis points, of course everybody has to cut their dividend. You don't even get a question. Why do you have to cut your dividend? Because everybody else is doing it. And so, it's that type of a thing that is the way that groups work, group think.
Yeah, I heard this story too about the Restoration Hardware earnings call was yesterday, and Gary's
Expletive.
yeah, and
Oh, is he swearing up stuff?
He told him his stock was down 44%.
Right,
he went,
'cause
oh, bleep.
yeah, he I guess what it was is too, he was saying, oh, well, the tariff's only 10%. And it's like, no, your stock's down X amount. And he's like, oh, Cambodia tariffs? We didn't expect that. But, looking back at all this too, does this put the Fed in play, Danielle? Like, where does this, I mean, how, as Jeffrey said.
Let me sing my tune.
Yeah, and let me just wind you up, and it's time for you to go.
So, as we were praying to God that your house didn't burn down, and as I was trying to get American Airlines to reopen DFW because there were fires in LA and there was an ice storm in Dallas when I was filming it at DoubleLine, it was an interesting time to be. Eventually, I just called Southwest and said, get me home. I know you're going to open Love and keep DFW closed. Wait, I just lost my train of thought.
There was something about a Fed. Does it
So,
put the Fed
right.
into play?
It's the
So-
Fed in play.
In LA, so I was having flashbacks to 8 phone calls
I can't believe
to
that
American
you can
Airlines.
call Southwest and get Love Field open. Powers to you. Anyway, let's go back to the Fed.
It's small.
Sorry.
In any event, my highest conviction call in Los Angeles earlier this year was that we would see 4 to 5 rate cuts. And I'm like, I don't think you quite understand how the unemployment rate works when the gig economy in the United States has acted as a massive shock absorber. So you've had millions upon millions upon millions of people, unlike 2009, right? Uber was born in Paris in 2009. Didn't exist then. We have millions of people who've gone, okay, I can get 12 weeks of unemployment insurance, $295 a week in Nashville, because Florida, North Carolina, and Tennessee only have 12 weeks, or I can go drive for Uber for double that. So I'm going to go drive for Uber. But Uber pay has started to decline. What does that mean? That means that this shock absorber has run out. And that was why I was saying in January that when the unemployment rate starts to go up, it's not polite. It skips up, and then it gaps up. And I think
It's the same as it's exactly the same phenomena as the high yield spreads market.
Exactly.
It's exactly the same.
I actually thought that when you were saying that. High yield spreads behave in the same way the unemployment rate behaves. The unemployment rate as of last month as of February, was 4.139%. So you could blow and it would have been 4.2%. And the Fed, in all its wisdom, has got a year-end unemployment target of 4.4%. Good luck with that. Now we've got 30% probability of May priced in. My call is for a 50 basis point cut in May. And it's just the calendar. They're going to have to go get Nikki leaks. They're going to have to pull them out because you've got first quarter GDP being reported on April the 30th. And then you have very, very early in the month, April non-farm payrolls being reported on May the 2nd, both of which occur during FOMC blackout, hence calling out Nikki leaks. And the Fed meets on May 7th. So you can tell me that the survey week for March non-farm payrolls was benign and that tomorrow morning's number can be just fine and dandy. You can't tell me that everything we've seen in February and March and April is not going to manifest in the unemployment rate going from 4.139 to 4.3 or 4.4% before the Fed meets in May. It's just mathematically, it doesn't make any sense. It just doesn't. So Goldman came out on Sunday afternoon and said, we're raising to 3 cuts this year. The sell side, and we're raising probability of recession to 35%. The minute they said that, I'm like, okay, we're in recession. Because the sell sides always last.
When I was on CNBC at the March, after the March Fed meeting, I told them I had a 60% recession probability. And that was the low end.
Pay you to be way ahead of the sell side.
That was my low end of the range, and they were, it's amazing when you get a reaction for something that isn't all that. I don't think that was a terribly bold statement, and they were like, wow, they can't control themselves because everybody's hurting. Everyone wants to be in a herd, so they're down at 15, 20. But
it's amazing. Even Apollo's I don't know if it was the CEO or the president came out today and said it's 1 and 2. Yeah, it was 1 and 2, and I'm like, even for private credit, Yeah, well,
it'll be interesting when those Dr. Slock emails change their tone. It's going to be like the Titanic moving in it. Anyways,
be interesting to see what happens because obviously private credit became very popular for the reason it almost always becomes initially popular, and that is public markets are analyzably not attractive, and that was at the end of 2021, when the S&P 500 using Shiller-Cape ratio, standard PE ratio, price to book, price to sales, all that type of stuff. If you just take the S&P 500 and compared it to how its valuation over decades, on a lot of them it was top percentile. So it was the most overvalued percentile you could be in. And on virtually all of like 25 or 30 of these categories, they were all in the top decile. And yet stocks were cheap to bonds at the end of 2021, unbelievably. So bonds were wildly overvalued. Treasuries were a joke. I mean, they were 1%, and the Fed was at 0, and anybody with a brain knew inflation was going to over 4% or higher, right? And so when public markets, you go, S&P 500 looks terrible versus evaluation history. Bonds look even worse than stocks on a comparison of the dividend yield on stocks versus the yield on Treasury bonds. So I don't like this. I don't want to buy stocks. They're overvalued. I don't want to buy bonds. And I don't really want to buy anything that's a lot easy to map stock and bond valuations over to it, because that means that will be, if I map it over, if I can, put coefficients on it and map it over, I'm not going to like this other category either, because so I have to buy something that I can't really understand. So let's see, what else is out there? Oh, you've got a SPAC you're opening up a SPAC, are you? What is that now? Oh, it's a blind pool, and we buy stuff. Well, what are you going to buy? Well, we don't know, and we're not going to tell you. And say, well, really? Well, you know what? Tell me how I subscribe into your SPAC, because I really love the fact you say you're not going to tell me what you're going to do. That's actually an attribute, because that way I can pretend that I'm not going to have this valuation adjustment that is going to occur on stocks and bonds, which looks to me are both going to go down. And of course, the other hook on private equity and private credit is the bogus Sharpe ratio argument. That, hey, the S&P is much more volatile than private equity. Well, that's because you don't market to market. That's like saying a CD has no volatility, and treasuries do. So CDs should yield less than treasuries on the Sharpe ratio argument. It doesn't make sense. When the stock market goes down 50%, I think we all know that private equity marks their positions down 20. And then when they both recover, the S&P goes up back to 100, and private credit gets marked back up to 100, and voila, identical return and double the Sharpe ratio. And the other problem is that there's tremendous illiquidity. They're defined by illiquidity. I gave a speech in Austin a couple of days ago, and the one before me was a private credit person, and her talk was essentially, I'm sure we've all seen these presentations that you just want people to start just looking at their phone. What they're doing is giving you a thinly veiled sales pitch for their private equity fund. And her argument began with the Sharpe ratio argument, and then went to the last 5-year argument. It's done better than other credit over the last 5 years. Therefore, buy the thing that's up the most, because it's like this secret weapon, that's always going to be up the most. So let's buy high and sell low, which is a horrible strategy, obviously. And then, then the other argument she gave that I thought was really kind of almost scandalous. She said, when you buy private credit, you can wait out the volatility in the public markets. Boy, does that sound like a mythology. I mean, you can just pretend. You should just pretend that you're still at par, but wait till the defaults come. And I don't know how many funds are drawdown funds, where they raise committed capital and they draw it down. But that's when it really, if that is significant in any way, that's a real recipe for disaster, because the illiquidity of the markets generally, which is obviously growing, institutions, in fact, a lot of major institutions run out of money. Harvard, with their $60 billion endowment, they had problems because their donors were pulling back because they didn't like the way they were treating the college protests. And so they were running out of, they were basically using annual donations as a pay-as-you-go scheme. And it allowed them to invest their money in a certain way. And their $60 billion endowment had to come to the bond market to raise a couple $1 billion to turn on the lights and pay salaries. Why do they have to do that? They have no liquidity. A $60 billion endowment can't scrape up $2 or $3 billion a year in cash flow off of $60 billion. So you know that they are locked up all over the place. And I remember in the really good times, like late 2008, we were raising distressed funds, and they did super, super well. And I had the opportunity to meet with the head guy at Stanford University's endowment. And he came in my office, and I went through this presentation that I'd done a million times, and it was incredibly convincing. It basically proved that you couldn't do worse than about 24% IRR, and you could do, and they ended up doing more like 40. But I proved, and I went through, I said, let's put in the assumptions, and let's put in assumptions that are worse than you believe they could possibly be. And that's what we did, and it came to 24%. And he said, I agree with you. This is absolutely a wonderful opportunity. I'm sure you're right, and you can't lose, but I'm not investing with you. And I said, why? He said, I have no money. And I said, well, look, you're a prestigious name. I'd like to have you on my client list, right? 10 million, come on. I don't have $10 million. He said, I'm actually selling off commitments to draw down funds because I can't fund them.
So there is a solution, and Barbara pointed it out to me right when I walked through the door. She asked me this really prescient question, and that was the other big shot across the bow this year, DeepSeek being the first. The second, bearing in mind that the non-banking sectors as of 2022 was 240 trillion and the conventional banking system's 180 trillion. So this whole private world is gargantuan, and it's much bigger than what is regulated. But Barbara posed this question to me. She's like, so what do you think about retail and private credit? And I'm like, well, they must have run out of money. As in inflows, as in people also trying to get away from their commitments, because retail is always the last thing you do. So the idea of, a qualified investor investing in private credit is just crazy. But the second shot across the bow was about a month ago or so, maybe 2 months ago, was when Zip Car Wash went belly up. And all of the pensions had the paper on their books at 95 cents on the dollar. And it went from 95 cents on the dollar, big, huge private credit deal, to Chapter 11. So it wasn't worth 80 cents on the dollar. It was just go stand in line with creditors. That's the illiquidity. And we don't know what any of this stuff is worth.
I have a client that has 8 that own the same holding. A couple of the 8 had it marked at 95. That was the high mark of the 8 different portfolio statements. The low mark was single digit. So either the single digit guy is very, very conservative, or the 95 guys are very, very aggressive. Yeah, I mean that kind of a range. That's the type of range we used to see in the illiquid markets of credit back in 2008, where you'd put bonds out and you'd have a 20-point range on the bids. It wasn't an 80-point range though, but still it's like 20 points, and that's what happens. And then no one knows what the market really is, and that's when the funny business starts, and that's when somebody wants to believe that the mark isn't really, the 80 mark is wrong. They'll keep them up there. Well, they're at par, but they'll mark them down to 98. And so they put it out to their investors, we're down 2%. And the investors are unhappy about that. And then they have to revise it that they're down 20%. And then they get the bankruptcy notice 3 weeks later.
So I'll never forget downtown Dallas when I could not wait for the elevators when I was working at the Fed, and I took the back staircase up to the executive level to go storming into Richard's office and say 22 cents on the dollar. Do you remember that when Merrill Lynch priced out its subprime mortgage book?
I
22 cents on the dollar.
I remember a similar situation with Citigroup. I remember I went and visited them during a really brutal period of that credit crisis. And I've never seen such panic in my life, because they were coming to grips with the fact that big blocks of their balance sheet were worth 0. big blocks of it.
And now today we're talking about the market structure and levered ETFs and the big banks lending into this space to finance them.
Yeah.
Well, is anybody else depressed? You know, because I can keep going up here. Let me try to spin this just a little bit. I'm going to put on a marketing hat. What do you guys like? Give me some ideas for these folks out in the audience, so we don't go drive our cars into the lake.
I always say in my case, I have a sort of a snarky answer for that. If you want to know what I like, look at my holdings. That's what I like. So what are the holdings? What have we been doing at DoubleLine? For 2 years, we have been cutting credit, cutting leverage, going up in credit for that credit that we own, minimizing triple Cs, minimizing leverage, and increasing duration on treasuries to more of an index duration. And when we were at the low in interest rates, the bond market had a duration of, in a traditional strategy, a duration of 6, and we had a duration of 2 going into that, and then we extended it out. And I like the 2-year, I like the 3-year, I like the 5. I've been saying this on CNBC on Fed Day for like at least 9 months. And I like intermediate term, like double B, triple B, maybe single A credit in certain pockets of the market that are not as rich as, like, similar to stocks, and it's always similar to stocks. Corporate bonds were very overvalued entering this year, and now their spreads are out and they're going to go wider. And so what was nowhere near the tights of all time were some of the securitized assets and commercial mortgages, which has to be very carefully, actively managed because it's not really a sector, it's a sector of sectors, and some of them can do well and some of them do badly. Some asset-backed securities, things like that. And I like non-U.S. versus U.S. stocks. I've been owning European stocks. For the first time in my career, I started owning them, I think it was in 2022. And they had been underperforming, and then they matched the S&P 500 for most of the subsequent couple of years. And now they're massively underperforming. I think it's just the beginning, because I think the dollar's going down. I think the dollar's going down because we have this ridiculous deficit problem that nobody has the courage to get to, but will be forced to get to it. We have an interest expense that has gone up so much, and it's going straight up unless rates, go back down to, 3% or lower, and maybe they will, I don't know. We have all this incredible deficit spending, and nobody wants to deal with it. And it's going to eat up such a fraction of the tax receipts under the current tax structure that it has to be restructured. The Treasury market will have to, unless we very drastically cut spending, we're going to have to restructure the Treasury market. Well, is that an insane thing to say? Well, maybe, except Scott Bessent, and there was a research paper subsequent, actually said maybe we should extend out the maturities on our foreign bondholders, which I suggest would be an extension of the maturity to infinity, and drop their coupon.
By the way, Jeffrey sent me an email that came in and said, "Boom."
Yeah.
I think they call that. Is that a perpetual strip?
I've been talking about this. It really occurred to me about a year ago. I just gave in a week. I gave about 8 speeches. I kept making this point, and I started to realize that there was more and more and more to it. So I had called up our government desk, and I said, for certain accounts where this is the most relevant, what I want you to do is, on all of our treasuries that we own, I want you to keep the exact same maturity structure, but I want you to swap everything that we have for the lowest possible coupon of that maturity. And stealthily, because I didn't want our competitors to front run us, we got it accomplished over about 2 weeks, and we took our coupon in treasuries from 4 3/4 to about 1.5. So that now, if they do what I think is possible, because it's been, I don't believe it's going to be all that administratively easy to just signal your foreign investors. I'm not sure it's that easy to do.
Well, not if you've made them your enemy.
Yeah. Well, this will make them an enemy even more. But I think they might do it to the entire Treasury market, because if the average rate now on Treasuries has moved up to about 4%, a 4% coupon. If you put it down to 1%, you would cut 75% of your interest expense. And that would let you hand off the grenade to another administration and make it somebody else's problem. So the Treasury market broadly is sort of a par type of a market. I mean, there's some discounts in there, there's some premiums in there, but 4 is the average coupon, so that's kind of where rates are now. So it's about a par market. That means that if your coupon gets cut, you're going to go way down in price. And 2 things I think are non-controversial as investment management business pillars. The first is don't take a risk unless you get paid for it, right? If the yield's the same, buy the one that's less risky. And if you can eliminate a risk at no cost or very little cost, do it, particularly if it's no cost. In this case, moving from the 4-handle coupon to the 1-handle coupon was actually a negative cost because the lower coupon bonds are off the run, which means they're slightly less liquid, and so they tend to yield a little bit more. So yeah, they're a little bit less liquid. I acknowledge that. But in a world of that type of a shock, I think treasuries, who knows how liquid they'll be, any of them. In that world,
Legally, you get a little more convexity in the trade too.
You get more convexity as well. So there's no reason not to do it, and that's something that I think may get more attention. That one way to do this is to you say like, well, the government will never be able to borrow again. Good, that's the goal. No government borrowing. It's just like. You get these people, they think it's a sign that they're coming of age. They're a real special person now because a bank gave them a credit card. That means they're a really sophisticated person who can afford to pay the money back. The bank would give me a card if I couldn't afford to pay it back. Yes, they would. Yes, they would. That's their dream come true.
So I would add to this, and we don't exactly have the same philosophy when it comes to the tenure, the two of us. However, I think that at times like this, you have to start trying to identify the babies that are being thrown out with the bathwater. And, I don't think Kohl's is going to be around for much longer. There's a laundry list of U.S. retailers that probably won't be with us. We've had 6,500 store closings.
What about Dollar General?
They'll still be with us.
Yeah,
but they're going to close
down. Closing like crazy.
Well, but even there, even they're seeing middle-income people trade down to them. Walmart's seeing higher income people trade down to them. But my point is, baby in the bathwater. General Electric traded down to like $4 way back when in 2009. It didn't go away. So I think a lot of retailers are going to go away. I don't think Target's going to go away. And I don't think Nike's going to go away. So start to identify brands, if you will, that you say to yourself, in 20 years' time, are they still going to be around? And if the answer is yes, then keep them on your radar screen for being great valuations. I think distressed bond investing, if things happen as I see that they're going to happen, I think towards the end of this year, you'll probably be in a good position to put money to work in distress.
Right.
And the third thing I would suggest is, and I just stumbled upon this, is every country has a widow stock that all of the little old ladies own in their retirement funds that pay nice big dividends that the government's not going to let these companies go. In this case, I'm referring to a Brazilian food company. And its dividend pays and pays and pays and pays, no matter what happens to the Brazilian economy, because the government can't let this company go away because every little old lady owns it and there'd be riots in the streets. So there are pockets of value. Yeah. And when markets start to sell off indiscriminately, especially when you see something like a Nike sell off to the extent that it is, put it on your radar. Because just like GE in 2009, it's still with us. It's not with us in the same form, but it's still with us.
Can you tell us what the U.S. little old widow lady stock is?
Maybe after a glass of wine or something. And it's about to list in the United States. Stock popped recently. I'm like, what happened? Because it's about to list on the NYSE.
Put another way, but philosophically similar. I remember in 2007 when I had got hit with those bonds, and I actually sold them out at a profit, thank God. But because I realized I'm not going to buy any of this stuff until it yields, double digits and all that stuff. I remember calling a strategy meeting with the group that was involved in that type of stuff and saying, our goal is survival. That's our goal. Because this thing, a lot of people are not going to survive. Our goal is survival, which is a broad concept of exactly what you're talking about.
Yeah, I mean, I heard the CEO, and I literally stopped in my tracks because I'm walking through my bathroom and I've got Bloomberg TV everywhere on mute. But for whatever reason, the volume was on, and I heard the CEO of Chevron say it's been 70 years, we've never cut our dividend, we're never cutting our dividend. And I said to myself, note to self, when Chevron gets really cheap, buy it, because they're not going to cut their dividend. And in certain companies, if they're well run, and you know that that dividend is safe, and you get in a baby with the bathwater situation where there's indiscriminate selling, you're going to have buying opportunities for things that you can hold for 30 years.
But by the way, Trump did tell us he's going to get gas prices down. He did today.
He certainly
Yes,
did, didn't
oil's
he?
down about $7 today. So
Yes,
7%.
7%.
7%.
7%. By the way, Trivial Pursuit, this morning in the chat room, somebody said, when was the last time oil was down 5%, the S&P was down 3%, and the dollar was down 1%. So this was early on in trading. And in the last 42 years, it happened once in 2015 with the flash crash. And it was a lot worse today, just to put today into context.
Yeah, in that flash crash, didn't Procter & Gamble go to a penny? And then they canceled the trades. It was the strangest darn thing.
Don't forget about our
people
nickel
always have
trades
to
they
understand
canceled on
that
us,
things can change, and it doesn't matter if the rules say this is forever and can't be changed and is illegal. The Fed has done a lot of illegal things
This is true.
that are against
I can verify.
the Federal Reserve Act of 1913. If they violated it,
It
they
stipulates
violated
that
the
you cannot
prospectuses.
own a government-sponsored enterprise. The Federal Reserve Act of 1913 says you cannot own a Fannie or Freddie bond
It's just amazing.
for several trillion.
Yep. I mean, it was like what happened to the prospectuses of mortgage-backed securities back in 2006. They said these cannot be modified. In plain English, it says these loans can never be modified. But they modified them. They said, then you had the problem with the GM pension. GM was going bankrupt, and they were having real problems. And so they took the senior secured bondholders and screwed them and put the pension plan in front of them. And it's illegal. You can't be doing that. So when people say they can't alter the coupon on U.S. Treasury bonds, how many times do you want to be Charlie Brown in the football with Lucy?